Good afternoon. A warm welcome to all the panelists and the participants to the webinar on impact of global bank failure on India. I'm Pratichi Avinash, Manager Marketing at R&M India. I request you all to actively participate throughout the webinar. You can share your questions, if any, in the Q&A box below, which will be taken up towards the end of the session. I hope this session will be insightful for all the attendees. Taking things ahead, I would now like to request Mr. UN Marva, Chairman R&M India, for the welcome note. Over to you, sir.
Thank you, Pratiti. Well, good afternoon, everyone. I, on behalf of R&M India, welcome all the participants for today's webinar on impact of global bank failure on India. R&M is a consulting firm operating in Delhi for almost 77 years and spanning 3 generations. Presently having our offices in Gurgaon, Bangalore, Mumbai, Raipur, and London. In March 2023, the Silicon Valley Bank failed, triggering a sharp decline in global bank stock prices and a swift response by the regulators to prevent the potential global damages. India also had an impact of the global bank crisis. In this webinar, we shall all be talking about the extent of the industries affected, how the impact can be minimized going forward, and the expectations thereof in the future and the preparations that ought to be taken care of. Before starting this session, I would like to introduce and convey my gratitude to all the panelists who have joined to share their experiences and expertise. Kaushik Vasudev is a certified CFA from the CFA Institute, USA, and has an extensive experience of 18 years having worked with Cognizant, ICICI Securities, and Elara Capital. He is currently based in UAE, where he is providing his services to Mashreq Bank and Yusha Bank, and is presently the Managing Director of Fiducia Capital Limited. Welcome, Kaushik. Gagan Mehrotra, of course, is a very old dear friend of mine and is a Harvard Business School alumni with an experience of 25 years. He's worked with HDFC Bank, Citibank, JP Morgan, Standard Chartered Bank, and is currently the portfolio manager at Cocogem Fund SPC Singapore. We have Somadev Dey. He's a management postgraduate from Symbiosis Institute, having more than 12 years experience, having worked with SBI Capital Markets, and is presently working as a senior investment officer at the Asian Development Bank. We shortly will be having Anaga Yudar to be joining us, who is presently in ICICI Bank and has worked in Deloitte, Aditya Birla, KPMG, and Credit Suisse. Lastly, I would like to introduce our moderator for today's session, Raghu Marva, the Managing Partner and CEO of R&M India. He's a qualified chartered accountant, joined the R&M team after gaining experience in the Big Four. He comes with an experience of 20 years and specializes in advising and structuring businesses overseas for Indian corporates, India entry strategies for foreign clients in cross-border holdings, merger and acquisition, and valuations. I hope this session will be interactive and informative for everyone who's joining us today. I would now like to take Raghu to take over the session.
Thank you so much, and hello to everybody.
Everyone who's joining us today. I would now like to.
I think
Thank you so much,
is very interactive,
and hello to everybody. Everyone who's joining us today.
Everybody can
I would
join us today.
I think thank you so much,
I think I'm going to start off by quoting from Urjit Patel's, the ex-governor of RBI, book, which said about overdraft saving the Indian saver. And in that book, for those who haven't read it, he had talked about aggravated moral hazard in the Indian financial system arising due to government involvement in financial intermediation, which is banks and non-banks. So in a post-pandemic world where the big are getting bigger, the importance of government banks in India has increased, and therefore the need for a stronger regulator is even more required. But as our illustrious expert speakers are going to explain to us, this is not an easy job. So with that, I'm going to start with Kaushik, our first topic for the day, which is bank run in the midst of a recession. What are the causes and effect? Hi, Kaushik.
Hi, Raghu. Thanks, Mr. Marva and Raghu, for your kind introduction. So, instead of making it a cause and effect kind of a story, if we just have to enlist what had recently happened in March, which is pretty fresh in the memories of a lot of investors, it was a kind of a jolt, right? I wouldn't even call it a banking crisis, which was actually a real crisis back in 2008, 2009. But it was the beginning of a confidence crisis in banks and financial institutions as a whole. It started somewhere in the US with a classic Silicon Valley kind of an episode. And then it almost, I would say, and it's still not over, but I would say it's almost find a bit of a closure in Europe. Fortunately, we haven't seen a huge spillover in the emerging market region. But what essentially had happened was the vulnerabilities of financial institutions, especially during a regime change from a low interest rate regime to a high interest rate regime, got exposed. So let's start with SVB. So what was the actual problem with SVB? SVB was one of those small boutique banks which didn't have a traditional large banking branch infrastructure, which typically a large tier one bank today has, right? It was one of those neo-modern kind of banking financial institutions which was trying to do something different, trying to enter into spaces which is slightly more digital in nature. And this is in contradiction to what the large banks are already doing. Now, typically, if you try and take a step back and see what is banks' basic business, banks' basic business today is to trade money. They take money from depositors and they lend to mortgage owners, they lend to portfolio owners, and so on and so forth. They earn a spread, right? That's the net interest margin, classic. Now, when you don't find avenues for you to invest, owing to the way you're currently set up, which is what I mentioned, you don't have a well-entrenched banking infrastructure, branch infrastructure across the globe, you typically tend to park your money in what you consider is a safe haven. In this case, it was long-term US treasuries and government-backed securities. Now, if we have to draw parallels to what happened in 2008, 2009, and what just happened a couple of months back, there's one word to it, which is complacency, and people taking for granted that things which are construed safe will remain safe forever, right? They need to understand that when they're parting with their money, which is what happens in a classic investment scenario, there is always a risk. And SVB and Signature Bank and almost all these boutique banks took that for granted. They didn't find very many avenues for them to go and lend and improve their credit growth and earn that net interest margin. Rather, they chose to actually park that money in long-term treasuries. Treasuries by themselves are relatively safer, yes. But then the moment you have a long-term treasury and you have interest rates not just going up, but skyrocketing. And by far, I would say in very many decades, at least in my limited experience, this is the fastest ever interest rate increase that one has seen. In a matter of few months, your risk-free rate of return went from as close to zero to about 5.5%, which is quite significant, right? And the system was fairly leveraged because you're still operating in the context of 6-7 year kind of a low to zero interest rate regime. And suddenly you see the risk-free rate kind of going up by 500 bips. It's a bit of a shock. So, and if you're owning these long-term treasuries and government-backed securities, and your interest rates suddenly go up, the valuation of those instruments on your books are actually going to start getting depressed. And that's exactly what happened with our friends like SVB and Signature Bank, which then suffered a confidence crisis. Eventually, there was a bank run. Many of the deposits were not actually under the purview of the federal authorities. That exposed a lot of vulnerabilities of some of the smaller institutions in the banking landscape. That also brought forth the regulatory responsibility of the Fed and other major central banks when it comes to regulating these institutions, because whichever laws actually applied to larger tier one banks didn't apply to the smaller ones. The regulations out there were fairly, I would say, a bit laid back compared to the larger ones, because they felt A, they're not global systemically important institutions, and B, we need to kind of give them some incentive to grow. So the regulations were a bit lax. And that's exactly what got exposed, right? So it started somewhere out there, which was, I would say, still a manageable kind of problem. But then when such events and incidents happened, and like Mr. Marwa was mentioning earlier, how life was very simple very many years back, when you had less media intervention, where you had less digital technology, where your information, I would say, processing wasn't as quick as what it is today, right? So whenever such events happen, your friends in the media are always on the lookout of, let's identify the poster child of a bad bank in today's world, and let's start asking people, more importantly, stakeholders, as to what their opinion is about the poster child. And that classic poster child happened to be Credit Suisse, which is already going through a bit of an issue in terms of the fundamentals, in terms of exposure to some large hedge funds, which went sour. They were printing losses in the range of $3, $4, $5 billion every year. So, but they were still trying to stabilize, right? I mean, you had a new CEO change and things had started to pick up. And it was at that time when there was this interview of the largest shareholder of Credit Suisse, which is Saudi National Bank. And the question was very simple. The answer was very simple, but that simple answer created a lot of ripples. The question was, do you foresee yourself investing more in Credit Suisse? And if an event like SCB had happened to CS, do you see yourself supporting Credit Suisse further? The largest shareholder, I don't think he really meant ill, but he clearly said that, look, we already have a lot of vested interests. We hold close to 10% of the entity. If we go beyond that, it will actually lead to a lot of regulatory implications for them. And amongst other reasons, they don't want to actually go and increase the stake in the institution. That was seen as, I would say, an exacerbation of the existing confidence crisis, where a large investor or the existing stakeholder is not seen supporting a bank which is in trouble. And mind you, we're not talking about a small bank like SVB or Signature Bank. We're talking about a 160-year-old institution, and in many ways has been, I would say, a benchmark for wealth management within Switzerland and globally. And such an institution's credibility got challenged. Fortunately, I would say fortunately, because all these things happened closer to a weekend. On Friday, the bank went and told the regulator, look, I'm not getting the right TRs from my largest shareholder. Will you support me? The regulator gives them a lifeline of 50 billion Swiss franc on Friday. But then that doesn't seem to be good enough, because people still have this issue with confidence in large banks, the way the interest rates are. You could see the markets kind of slowing down. So, questions start building up. And I think everyone had a sense that this might potentially not last too long, because the deposits were getting pulled out at the lightning speed. So like I said, fortunately, it all happened over the weekend, because it does give all these large stakeholders, including the regulators and the competitors and everyone, to take stock of situation and see what best could be salvaged. And that's when we saw possibly something that we had not seen ever, I would say, in the banking landscape, where a regulator like Swiss National Bank actually stepped in and hastily kind of organized a deal between the largest institution, which is UBS, and the second largest institution, which is CS. And it was like a forced marriage, right? To start with, mind you, UBS didn't want to acquire CS. These discussions were always there, primarily because of a lot of overlapping interests. But just imagine, on Friday, you have 160-year-old heritage institution still alive. And on Monday, that institution was gone, right? It just got absorbed into another mammoth institution. That really didn't send a lot of comfort to many investors. So from my perspective, when I manage client money in public markets, we do look at bank bonds as one of the quality credits post sovereign bonds, right? Because you do typically tend to assume that a large bank is too big to fail, and that's systemically important, and hence it has a lot of backing invested interest. So, and if you're holding a bank bond, it should be okay, right? And overnight, many of our client portfolios, and I'm talking about like really blue chip $100 billion banks like HSBCs and so on and so forth, right? Well, literally the senior bonds of these instruments, they were marked to market down by 15, 20 points in a matter of a day. And if you look at a bank capital structure, a typical bank's capital structure, you have your deposit holders, followed by your senior bond holders, the senior bonds that get issued, which have the second priority in the event of liquidation. And then comes your subordinated instruments, and then come what you call as a hybrid instrument. The subordinated and hybrid together are what is classically called as a bank capital. Basically, these instruments were created mainly post 2008, 2009 as bail-in eligible instruments, because what happened in 2008, 2009 was when such bank failures happened, governments had to dip into taxpayers' money to bail out the banks. The learning from that was you have to create instruments within your bank capital structure so that in the event of stress, liquidity stress, real stress, where the bank is not able to support itself and is bleeding through losses, these instruments will get converted to equities or will get written off and support the core bank capital. And then come your equity holders. Now, a never seen before incident happened, which is when CS got taken over by UBS. And mind you, CS really didn't have a fundamental issue, right? It was just that the pace at which the deposits were actually getting drained led to many people extrapolate that potentially the institution might not survive and it might actually need a lot more bailout. So despite the credit or the credit line or the aid given by the Swiss National Bank on Friday, they still decided that the institution could be unviable. And then potentially it's a bailout scenario, technically. So some of these instruments which I spoke about, which is your hybrid instruments, which in the financial parlance, we loosely call them as perpetuals or contingent convertible instruments or COCOs. Those got written off. So we are talking about $17 to $18 billion worth of Credit Suisse hybrid instruments getting literally written off to zero. So much so that what we have seen is the FDIC, the Swiss National Bank and FINMA, they came out with a circular to many of the custodians saying, just remove this line item from your client portfolios, as if it never existed, right? So an instrument which is trading at about 60 cents to a dollar goes down to 0 cents to a dollar over the weekend. And that has led to repricing of a lot of these financial assets in the market. So today, from an investor standpoint, if you're investing in bank capital, be it you're an equity holder, you're a bond holder within a bond, you're a senior bond holder, or you're going to be a hybrid or the perp bond holder, you're now asking yourself a question: can I really take these perpetual instruments seriously if I'm really investing in them? So today, some of these perpetual instruments are trading at dirt cheap valuations, never seen before valuations, huge discounts. And some of the senior bonds are trading very tight, Because what happened post CS episode was the senior bondholders were saved, but the subordinated bondholders were impacted. The equity holders were anyway kind of, were the mercy of whatever had to happen, right? But the worst affected were these perpetual instrument holders, essentially. So it created a bipolar valuation structure within the bank capital that still exists. And post that, we had a series of regulators, like from the European Central Bank, the Bank of England, from the PBOC, everyone actually coming out and supporting their own banks, and those which issued these perpetual instruments. And they said, look, it's a black swan event. It's a once in a blue moon kind of an event which SNB acted upon, and we are not going to do that, right? So you guys should not actually be too concerned or perturbed about it. But even now, the scars remain, and investors are not really taking those instruments, liking to those instruments so seriously. So it's created a lot of bipolar, I would say, valuation structure. Even for an equity holder, if you look at a classic XLF ETF, right, which plays on US financials, or if you look at a European stocks ETF, which is like a benchmark for US banking industry, they have just come back to the pre-COVID highs.
Right.
Over the last 5, 7, 10 years, they have really not created a lot of value for their shareholders, despite a large accrual in earnings of these banks, which means the valuations have just gone to rock bottom. And the confidence pricing, that's the reason why I said earlier that it's still not over, right? It's still kind of lingering on.
Yeah.
And from a wealth management investment standpoint, for an offshore investor today, that creates a lot of opportunities. Because today we are living in a world where some of the emerging market players who are not as complicated in their business models like some of their Western counterparts are thriving. They're doing really well.
Yeah.
And those Western counterparts which are in the limelight, which have gotten into a little too complicated kind of a business model where they just don't have a regular banking risk, now they have a counterparty risk and off-balance sheet risk and so on and so forth, tend to kind of, suffer a bit. And just as a case in point, today, a UBS's, a Deutsche Bank's, a BNP's market cap put together is just equal to that of an HDFC Bank's market capitalization. So it kind of brings me back to one simple thing is keep it simple. Just focus on the bread and butter business of banking, which is trading money, raise money from depositors, identify proper infrastructure for your credit transmission and for credit growth, make your net interest margin, keep your asset quality in check, you should be okay. If you're going the SCB way of trying to go into a neo-banking kind of a system where you want to bypass this, you're not a bank anymore, right? You're an investment company.
Yeah.
The risks are totally different.
Yeah.
Or if you want to go the CS way of trying to go pretty much into slightly exotic kind of banking and fee-based business model than your traditional banking infrastructure, maybe you're just getting into complex waters which you don't really want to tread, right? But then if you look at the classic businesses like that of HDFC, even some of the Chinese banks, despite all the real estate problems that they have gone through, and some of the Southeast Asian banks, well, even within the European banking landscape, those that have kept it simple, including Crédit Agricole, BNP, they have remained relatively unscathed.
Yeah.
So the learning or the takeaway from this is just focus on keeping the business simple.
Yeah.
And the implications won't be so drastic.
I think that was an amazing takeaway, the way you brought all of it together. But for me, I think it was the speed at which it all unpacked. I think that was, the amazing part of it, how quickly, like you said, one weekend to the Monday morning, how quickly it all unraveled. And that's what I think got everybody really badly jittered. And like you said, confidence takes time to get built back. Great. Thank you so much, Kaushik. We're going to very quickly jump on to Gagan Bhai, who is going to take our second topic on contagion risk. So Gagan Bhai, I'm going to start off, after the big six that Kaushik has hit out of the park. We are in IPL season right now. What do you think? I'm going to step a little back, take you to CRS, right? So, the OECD CRS transparency norms, according to that really brought in a state of flux. from there to now, where, what Kaushik just mentioned, where we are at, that you may have some weak banks which are got a complicated business model, not keeping it simple, are going through rough weather. Do you think that the seeds of that was somewhere sown when CRS and OECD had brought in, much higher transparency? Over to you, Gagan.
Thank you, Raghu. Thank you, Mr. Marwa. Thank you for putting this together and inviting. Yes, Raghu, you're absolutely right. When CRS happened in 2016, 15, 16, it was implemented in its full form. Literally, the world was flattened out, right? And as a consequence of the flattening out, clearly there were just 4 or 5 winners as far as the wealth centers, international wealth centers. And I'll focus only on offshore international centers were concerned. So it was US for sure. There was UK, Switzerland, UAE, Singapore, Hong Kong, right? And that's where practically where the entire world got, bulk of the world's got attention and diverse converged in, right? What has happened is that, in the last, I would say, ever since the war in Ukraine, that space has again got reshuffled, right? And to my mind, other than UAE, there is no other neutral jurisdiction, right? All other jurisdictions, all the names that I took, either they are aligned or they are conflicted, right? And which is where it picks up as an investor. One has to be sure, what do you want to do? So let me put it in perspective, right? Before we go to contagion risk and all, the questions one has to ask is that, we know KYC, we know your customer, you know your banking, we know your bank. The question nobody's asked is know your central bank. How much who's going to backstop? So the question, okay, there was a Credit Suisse, it was, $600 billion, $700 billion in private banking assets. All group assets put together were $1.8 trillion. But, what was the backstop? $50 billion, right? Which was like 2-3%, right? So that between a Monday and a Friday, if 3% wiped out, was that all that was there for a backstop? Now, the previous speaker very explicitly explained the Credit Suisse problem, but, what is very, very clear that, the risk for appetite for backstopping is something that one needs to be clear. So the question as a real investor needs to ask is, look, if I'm going to Singapore, am I going to a Singapore bank? And let's not get jurisdictional. Let's say I'm going to an international jurisdiction. I am with a local bank and I am with a branch of an international branch operating in that jurisdiction, right? If there's something were to happen to me, who gets backstop? Does the local bank get backstop or does the international bank get backstop? And then who provides, suppose I'm with the international bank, who provides the backstop, right? Does the jurisdiction, the local jurisdiction provide the bank or the parent jurisdiction provide the backstop, right? Who's going to provide me the backstop and how much, right? Now, I remember 2008, we were on the desk and, when Lehman hit, Singapore had come up with a beautiful way to backstopping. They said, as long as any assets, any bank, any branch operating out in Singapore and assets booked in Singapore, we will provide complete backstop to all those assets, right? Now, that level of confidence, which other regulators can come up with, right? So, before we get into the domino effect, the complexity of the very fundamental nature of the question, who's my banker? Where am I going to book my assets? Who's the bank? Will I get backstop? All these questions have now suddenly become relevant, right? Am I going to a small bank in Switzerland? Will I get the same backstop as UBS got? And who's providing? Suppose I'm a cantonal owned bank, so will the canton provide? Does the canton have money? So there are the nature of those questions have become so complex. Credit Suisse is a beautiful example. The regulator decided to delete the line item that was the instructions to the regulators, but without providing any corroborative evidence, right? So the question is that can it happen to other jurisdictions, right? So the complexity that exist today are not what it seems. So, as the tip of the iceberg. Look at you know look at EU. It's a socially disturbed. The entire continent is socially disturbed. It's been, I would say, the business model, the social model, everything got dislocated, and more so after the war in Ukraine, right? So, where do we does the one take the money, right? Who look at currencies have been weaponized. So what currency do I hold? What currency do I hold? How much do I hold? Uh, what do I do with my money, right? So, and what currency should I hold is all very, very relevant. So, that is what, brings us to the opportunity that India has. So, Raghu, in a global macro environment that we operate, rather than trying to worry about what is the next domino that's going to fall, right? I would say, this is an opportunity for India to come back. And, I would reckon the steps that are being taken are in the right direction, but at a very slow pace, right? At a slow pace. You know, the UPI and UPI Singapore connectivity is a great idea, but how much of that is actually being used, right? The tax consequences of how much can you go and shop in Singapore? Will it be out of your LRS earnings, or will it be out of your domestic shopping list? Those questions have not been asked by the government. You can provide a bridge, but you don't clarify that, and then you have the taxman chasing you, right? There is a beautiful concept being created in Gift City, which what Marwaji was alluding to. Now, we need to beef up that regulation. India today can become a great banking destination for international, international investors looking, especially Russians and etc., looking to book their assets, right? After all, what is Switzerland? 6 trillion in public assets, international private assets, and 880 million, less than $1 trillion economy, right? 880 billion economy. So comparatively, our opportunity to hold international assets is humongous. But we need to be clear. Will they be taxed? Will they not be taxed? What subject, which authorities can chase, what kind of sanctions will impose, whether if there is what currencies will be traded. So that infrastructure, the entire infrastructure needs to get beefed up very fast and very quickly. Opportunity for India is threefold. I can break it up in three parts. One is the currency itself. Rather than getting into, your currency needs to be available, right? I've been to Dubai, and I've been oft in the last 12 months asked if I would like to settle my bills in Indian rupees. But I would love to see that more often in many more countries, because what is happening is, by de facto, those countries, there creates a demand for the rupee. They become reserve holders for the rupee, right? The moment you create a demand, you offset your net oil importer, right? Now, when you're a net oil importer, you're perpetually under, you have a need for dollars. But if you can create a demand for your rupees elsewhere, that gets counterbalanced somewhere. I'm not saying the rupee is going to suddenly appreciate, but it takes the pressure off the depreciation, right? And if there's predictability on the rupee, then that's where local businesses start thriving, right? So it's a huge opportunity to do that. Today, why is a MasterCard or Visa, why cannot that be replaced by a RuPay Connect, right? And rupee be used by, let's say, Russian investors, etc. Second, of course, is robust and clarity in regulations. Regulation has to be. I don't think that, I'm a proponent of Singapore, and I'm slightly conflicted, having spent 20 years there. But the beauty of the jurisdiction is that the laws are very, very clear, right? They have thought through all the knots and crosses, and they ensure that proactively deal with the tax consequences and everything. What is needed to onboard an account to what is how do you operate an account? What are your the Indian thought process has to get there should be like a compendium, right? And a bank operating in Gift City should be able to pick up and say, okay, this is the manual that we're going to follow, rather than looking at revisions, circulars, reference the previous circular. So that fundamentally that thought process has to change. Third, of course, is the entire rupee infrastructure. I attended that part first because, to my mind, that's the best way to manage your inflation, manage your currency. Is that that UPI, RuPay connect, and the fact that it can be traded. It can be traded. Rupee LCs can be opened. So it's a great opportunity. So India, to my mind, sits on a gold mine of an opportunity. Right now, how we encash this and make it our opportunity is a big challenge. And India can provide the depth. Look at, and I'll give you a very simple example. Today, SIPs in the Indian mutual funds are almost 14,000 crores, almost 1.8 billion, or 1.7 billion dollars. Right? They have provided the best QE in the last 24 months when the world markets were coming off. The SIPs kept the index money up there. The index on a bad day went down to 55, on a good day 57, and then it's been range bound in the region of 60,000. Now, where that range boundness has come because it's provided a base, right? And that base can come to the currency, to the other parts of the economy. It can be it will be a tremendous upside to the economy. But work needs to be done, and at a very fast pace.
So that's a vote of confidence from Gagan Bhai for India. I think if we believe the contagion risk is contained, or at least for the moment, India seems to be an oasis of peace in a world which is becoming more and more complicated. The way Kaushik explained it to us. So that's great to hear. I think a vote of confidence from a resident of Singapore for 20 years. That's really great. We're going to shift very fast onto our next speaker, who's Somadeep. And Somadeep, where the topic, with you is the impact, right? What is going to be the impact of, SVB, Credit Suisse? Kaushik talked about the confidence that has gotten shaken across the board with everybody. What as per you would be the impact on, say, the Indian startup or the tech? Are the tech back offices? I mean, anyways, there's a little bit of a weakness that's going on in the tech space worldwide. Do you think that with these two bank, I don't want to call it crisis, tremors, is that going to get exacerbated? Over to you, Somadeep.
No, thanks, Raghu. Don't think that this is going to come to India and impact India in a way. I mean, as you call it, these were tremors, right? And these were tremors, at least from an Indian startup point of view, for just a period of 13 days between the settlement of SVB from the day that crisis actually happened. Within that period, whatever concerns were there, those concerns, at least the government came in to support to the best of its ability within such a short span of time to help at least activate and reduce the red tapeism within our overall bureaucratic system to ensure that some of the startups can transfer their funds from one entity to another, as in from SVB to the accounts of Indian banks. So that saved some of the concerns. But still, there were a large chunk of startup funds whose money got stuck. The FDIC settlement, which happened, at least how it pans out, it's something which we all will have to observe over the course of the next few months. But as of now, at least it addresses the key concerns, and primarily from the depositors' point of view, which is where we were always concerned. But there are still some regulatory challenges, which is basically the second order impact, which may happen on the credit side. How does the credit where these Indian startups have taken money from SVB, where does that money really go back to? How will be the impact of whether there is a default, who handles the default, how the default is handled? This entire, on the other side of the balance sheet of SVB, I don't think there is a clarity which has emerged from the FDIC guidelines that has come up till now. Even there, the suggestions are primarily to reach out to specific officer, find a solution. So there is no clarity on that, and it will be a case-by-case fix, which, as it appears today to me, will be done. So there is some concerns, but that's not what is going to lead to massive risk for these entities. It may cause some disruption, will cause some management bandwidth, but it will certainly find a solution to those issues. But what it essentially does, as just Gagan Bhai mentioned a little while earlier, it opens up a huge amount of opportunity for the Indian banking system, where these startups really need to start looking at the Indian banking system and putting their money within India, and Gift City is honestly a very, very strong and a great option. And I share a little bit of more optimism around the work which has been done in Gift City. Government is committee or an organization within the Gift City, which is essentially trying to bring in all regulations together. And for any entities that is operating out of Gift City, that is the only single point of contact for any kind of approvals. So that has fastened the process. And in terms of the overall banking system, there is a fair amount of interest from international banks to come up and set up establishments in Gift City. In terms of the deposits that we are seeing for at least the Indian banks which are present in Gift City, rising fairly at a good speed. And even the other segments, the exchanges which are there in Gift City, those are operating pretty well. There is some traction in some of the products, which for gold being the primary example. In the other products, even as a country, we are not very strong in interest rate derivatives and others, even in our national exchanges. But even in those products, there is some liquidity flow which is happening towards those products, and that can be seen as of now. The next part is from where does it go for this overall? I mean, there are talks around de-dollarization and all. How will these startups really face that if that really were to happen? I don't really believe that dollar is going to go away anytime soon. Even if it has to happen, it will be a complete disruption in the world order if it has to happen overnight. And I don't think any country in the world has the appetite to absorb that, especially under current circumstances. And hence it is going to happen at a slow pace. And even if you look at data, I mean, the overall reserves that is represented in USD, I mean, that has fallen from 73% to about 58% in the last 20 odd years. And yet we have not really seen dollar going away even today, right? And then there are other considerations, right? There is no other currency which is as liquid as the US Treasury. Even if people have to invest their excess money, I mean, the central banks, where do they go and invest? It has to be an US dollar, because no other country provides so much of liquidity for anyone to go and invest in them. So dollar is nowhere to go. And even if it happens, it is going to happen at a much smaller, I mean, a much slower pace compared to what probably is now being talked about. Again, in terms of, and specific to rupee, the way at least as it appears, the way Indian government is approaching the whole India's effort towards strengthening the rupee and the de-dollarization, is India is primarily focusing on establishing rupee connects with countries where India imports from, which is Malaysia, from where we import a huge amount of edible oils, Russia, where we import a large amount of the oil and other fossil fuels. So is Iran. I mean, those are the areas which are being targeted, because that just reduces our dependency on the dollar, as well as, and as Gagan Bhai rightly mentioned, and it helps strengthen the rupee and gives it some stability for us being an import dependent country for a fair number of products which we import. And the banking system overall in India, the banking system in India is fairly strong, right? And that's why we did not see any of those impacting the Indian banking system, although there was a confidence issue and the stock market got impacted, but the fundamentals of the bank held, and obviously there was an immediate correction in prices also there. I mean, it's fundamentally for the reason that 65% of our deposits are into loans. The money that they get from depositors that goes into loans, and only 25% of those are investments, right? And those investments are again HTM investments. 80% of those are HTM investments. There is no reason of Indian banks making losses which goes beyond 10 to 15% of their capital on the remaining investments which they are doing. And all the banks in India are stable enough to at least provide for such kind of losses if it were to happen. So hence, for the startup ecosystem to conclude, there is a necessity to diversify, and however small you are, because the larger ones are diversified and they at least did not face an immediate challenge. But the smaller ones which did not diversify, they face the challenge. So it is important for them to diversify their operations so that they are not dependent on one single economy, one single currency, if anything were to happen to those. And India is a great option for for these entities to rely on. And India is now providing enough opportunity for foreign currency to be held in India through a gift city as an option. So that must be explored by everybody. And I'll leave it at that with that note of optimism.
Thank you so much. I think that was great. A sum up that you did. That a second vote of confidence on India, on the Indian regulator, as well as on the Indian banking system. That we couldn't have any better. With that, I'm going to move very quickly to Anaga, who's the last, but we've left it the best for the last. Anaga, the topic is impact on interest rate cycles. Even today we were talking a lot about whether it's a pause or whether it's a tactical shift. Where do you think the interest rate cycles are going forward? The US Fed, Bank of England, and RBI seems to be going in different directions based on our separate local economies. Over to you, Anaga.
Hi, good afternoon, everyone. Am I audible? Okay. So a very interesting conversation we've had so far. I was listening to the previous speakers very carefully, very intellectual conversation. And like you said, we've saved the interest rate part for the last. So I'm not sure how many people read the monetary policy minutes that were released yesterday and where the RBI paused. So let me start with the Federal Reserve, because US economy is the largest and Fed's decision impact the global markets, the global central banks. So to begin with Fed, I think, when the last minutes came, we got to know that there was a conversation or some members considered pausing because the global financial crisis that happened, the banks' failures that happened. And there was a concern about financial stability and the rapid interest rate hikes that we have seen. Fed has hiked rates by 450 basis points in a very short period of time. And there were concerns that the rapid monetary tightening that we are witnessing, is it exposing fault lines in the banking system? And what does it mean? Because bank failures also mean lower access to the more difficult access to credit and credit becoming more expensive. And at a stage where you're already staring at recession, the global economy, the growth is going to slow down. A lot of countries are already into recession, and globally, including the US and emerging markets, growth is going to slow down. When you're already staring at recession or a slowdown, can you afford to have tightening financial conditions and access to credit becoming more expensive and more difficult? So certain Fed members did consider pausing last time. But unfortunately, the situation where we are currently, interest rate inflation is very high, still very high, even after rapid monetary tightening. So we cannot afford, we don't have the luxury of stopping the rate hiking cycle just yet, because there is this possibility of bank failures or banks are failing. So I think what the Fed did was they did the right thing, or the US regulators, they did the right thing. They provided backstop. They contained the crisis and made sure that if a crisis like this happens again, the depositors are well taken care of. But the monetary tightening has continued. And there are expectations that we don't see inflation in the US coming down anytime soon. We believe that we still remain at around 4%, which is 2x of the target. So I do believe, and our in-house view is there's definitely one more rate hike left in the US. So we do see a 25 bps hike by the Fed. And what it means for, I know ECB, for example, ECB is in fact is more localized and much lower compared to the US Fed, but we do believe that ECB will also continue hiking rates because inflation in Eurozone is also very high. I think 5.9 or 6% was the last print, which is 3x of the inflation target of 2%. Bank of England, the UK is expected to slip into recession, and their interest rate is 10%, above 10%. So I think globally, everywhere, central banks still have some way to go before their rates peak. And what this means for India is most impacted by the Fed. And our domestic inflation was very high on this side. But the last print has given some comfort. And if you look at the projections, our in-house view is in Q1 of FY24, we see inflation at around 5%. It will pick up Q2 onwards. It will be around 5.4% in Q2, Q3, and 5.2% in Q4. And for the full year FY24, we see inflation at somewhere around 5.3%. It's still pretty high because the target for us is 4%. But at the same time, what we need to be careful of is are we over tightening? And that is what the monetary policy members are concerned about. They're saying that the impact of interest rates is way more on growth than on inflation. So you will dampen growth way more than you will control inflation. So we shouldn't be over tightening, especially at this stage when growth is already slowing down. But we also have to keep pace or keep up with the Fed because if the interest rate differential widens, there are outflows out of emerging markets, and that is something we again don't want because it has implications for the rupee, it has implications for the external sector. So I think that is one reason why the MPC kept the stance of monetary policy at withdrawal of accommodation, because they want to keep that option open that if Fed continues to hike, so 25 bits I think is a given, but beyond that, if the Fed continues hiking, we should be able to, or we should retain the flexibility to hike step in step with the Fed. But I think in my personal view, like I said, Fed, we believe one more rate hike of 25 bits, and I think in India we are done because domestic inflation has started coming down. And if you look at all other factors that come into play, if you're talking about liquidity, if you're talking about real rate of interest, if you're talking about growth, if you're talking about the external sector, all these indicators say that this is where the peak should be. Any more tightening beyond this will eat into growth because already we are at 7% growth in FY23 and expected to fall to 5.9% next year. So there is already slowing down, and hence there is no need to hike rates. In India, in my opinion, we are done with the rate hikes. And just quickly coming to this whole concern or this whole issue that was raised, that in spite of all the monetary tightening that has happened, 250 bps in India, credit growth is still very high. Credit growth is still in double digits. So this monetary tightening has not had any impact on dampening credit growth or making credit more difficult. And I think there are a couple of reasons for this. First, it's a base effect because last year credit growth was quite low. And the second and the more important reason is inflation, because credit is a nominal indicator and inflation was so high. Credit growth in nominal terms was also very high. So I think that is one reason. So we shouldn't interpret it as monetary tightening has not been able to bring down credit growth. I think on the contrary, we are seeing some moderation in credit growth as well. So I think overall the economy is still a bright spot globally. We are still the fastest growing major economy in the world. But we like the NPC members also believe that I think this is the peak, and beyond this, if we hike, there is a risk of further tightening.
So I just want to jump in with 2 points, Anaga, to follow up. One is obviously we're going to hit general elections very soon. Next year, 2024 is general elections. So maybe that is also playing at the back of the mind of the regulator to not reduce growth so much that general elections comes, people are really unhappy, and you probably don't want any surprises over there in 2024. And the second aspect is about the GST collections. In spite of growth falling off, like you're saying, for next year, our GST collections continue to be very robust. And any other thoughts, regarding recovery? I think the other day we were talking about the SME sector doing better than probably the large cap. So any other thoughts that is coming out from your data point? Over to you, Ananda.
Yeah, so see, talking about inflation, yes, you are right. There is an inflation coming up, and there are a couple of things that probably the central government and the RBI has reserved. They will do just before the elections. I think a couple of things are the first thing is petrol and diesel price cut. So although global oil prices have fluctuated, the domestic pump prices haven't kept pace with that. And there is a possibility that just ahead of the election, it can be, some sort of, the government can provide some sort of cheer to the public by cutting the excise duty on petrol. That is one thing. And coming to a rate cut by the RBI or the MPC ahead of the election, I want to reiterate that RBI is an independent central bank, and it will not, really play into the election. Will not play any major factor in the RBI's decision making. But you're right. I mean, the timing is such that anyway the market is pricing, or the market is expecting a cut by the RBI in the last quarter of FY24, and that is just before the election. So I think you can say that it's a coincidence, or you can also say that it can provide a cheer to the public. But yes, there is a possibility that maybe a couple of months or maybe a quarter before the election, we can see a rate cut. Coming to the credit growth, by the size of industry. So what we are seeing is the industrial credit growth as a whole has started tapering off a bit. And there are a couple of reasons for this. I think the first and the most important reason is the working capital requirement of industries. That has come off, and that is mainly because of commodity prices coming off. So if you look at the components of industry credit, all the sectors that use commodities as raw materials, we're talking about petroleum or base metals or any of these components, their credit growth is quite high, but it has started coming off because of commodity prices coming off. And services credit growth has remained very strong because that is where the normalization is happening. During COVID, it took a hit, and now it's coming back to a pre-COVID level. And that is why services component is seeing robust service growth, robust credit growth. And by size within industry, large corporates that do have access to other sources of credit, for example, they can borrow from abroad or they can borrow in the corporate market, their credit growth from the banking system has started coming down. But smaller companies, MSMEs, for example, or medium-sized companies that are predominantly dependent on the banking system for credit, their credit growth has kept up.
Thank you.
And sorry, the last point that you mentioned about GST collection. So I think we have seen that GST collection of 1.2 or 1.3 trillion a month has become the new normal, and that has improved significantly. And like I said, 1.3 is the new normal now, and that I think that's indicative of two things. One is a robust underlying economy, and the second thing is also compliance gains, because the taxman is watching, and there are all the loopholes have been plugged, and that is why improved compliance is also one reason why GST collections have improved significantly.
Thank you so much, Anaga. I think even Gaganbhai had reiterated about compliance and the taxman. I think overall everybody understands with the greater e-governance that has gone in, there is also an aspect of the big brother, which is somewhere or the other improving compliance and creating that little bit of a fear of God. I think with that, we're going to jump into the Q&A. We've got a question which says, do you see only few banks like HDFC, Kotak and SBI being fundamentally strong? Rest of the banks like UBS, Bandhan Bank are not so strong. Kaushik, would you like to take a jab at this? What is your take on this?
Okay, so like I said, I think when we talk about these regional banks, a major driver would be how the regional economic growth continues, right? And I think the preceding speakers have laid that out very clearly, that that seems to be fairly strong. And it brings me back to my original point of keeping the business model fairly simple. As long as you're raising money from depositors and you're lending money to asset owners, and that's your business model, I think you will still survive. Now, relatively, which one can do better is a function of how attractively they start pricing their assets in the market. And from that perspective, my bet has always been on some of the large private sector banks, which have had the infrastructure and the ability to be able to do this job a lot better than their regional counterparts. I've never been a great fan of the PSUs or the regional banks, which have a very limited operating scope. And that's one of the reasons why I'd still kind of stick my neck out and be supportive of some of the large private sector institutions.
Thank you so much. Thanks, Kaushik. Can I invite any of the panelists? Maybe they have some Q&A amongst themselves about what some of the previous speakers said, or maybe what Anaga talked about, in terms of the RBI independence and regulation. I started my surmise saying that was something which was very important. Does Somadeep, would you like to share your views on that about the independence of the RBI or the independence of the regulator and how strong they are?
No, thanks, Raghu. So I work across South Asia and have met a fair number of regulators in Southeast Asia as well. RBI is by far a very, very strong regulator compared to other jurisdictions. And the benchmark is probably an US or an European regulator, but the bare banking system is such, and the way that has progressed in the name of innovation and probably independence to the banking organizations, those regulators' policies are fairly weakened, and so is the monitoring. And most certainly, RBI's monitoring is the strongest in the industry. I have been lucky to observe some of the RBI's monitoring report on some of the banks in India. People can take quite a bit of assurance that there is a regulator who is doing its job and who is doing that job really thoroughly. And RBI, in terms of at least in the recent days, the way it is reacting to market scenarios and especially evolving market scenarios, they are less reactive and more proactive. There is room for improvement, but they are certainly less reactive and more proactive. So, which is a great thing for anyone to take confidence from in our central bank.
Super. Another vote of confidence. We're going to end with our last question for the day, which is on nationalized banks. Obviously, we've grown up thinking nationalized banks because it's backed by Government of India, which is sovereign backed. So is that not a safe haven? Is, Kaushik mentioned about, private banks being the torch bearers of, caution and risk mitigation. Gagan bhai, what is your take on this? I invite your views on, PSU versus, we've got Anaga, so I'm not asking her, she's representing, India's one of largest private banks. So Gagan bhai, what's your view on, this whole PSU versus private?
See, Raghu, it's a very interesting space. There is a spectrum in that extends from SBI at one end to small cooperative banks at the other end, right? Let's take the cooperative out. Let's say even a small PSU bank, right? We've seen that a Nirav Modi can happen and a Gitanjali Gems can happen out of a large bank out of Punjab National Bank. But on the same side, SBI has come out to be a very robust institution. So the policies exist. It's not that, the private sector is any safer than the public sector. Rogues can happen anywhere, right? The government has stood behind the entire banking system, even if it was Punjab National Bank, right? And to my mind, that's the best case that one can allude to, right? It was a rogue institution, that there was frankly a lapse of processes. But it's not that the processes are not in place. The processes are in place. Look at the case of SBI. For everything, they follow a committee process. If people find it frustrating, it's slow, but the giant still dances, right? And you get things done, the thing moves, they've managed it well. And India does not need 5 banks. It doesn't need 5 private banks. It needs hundreds of those, right? If India has to grow and, they have to get to the top 3, top 4 economies in the world, we're still number 5, number 6, right? So to just climb that notch of 2 ladders or 2 spaces on that ladder, we need at least 10 more banks. The credit offtake is still very poor. It has to increase. The consumer market has to grow. The depth in mortgages market has to grow. Frankly, why should mortgages in India be priced at 7% and the West be priced at 2%, right? At the end, the banks are working on a spread, of roughly 3%. The cost of funds can come down so they can deposit rate. So all those things need to get addressed. The economy has to grow. We need more banks. To my mind, the banking sector is pretty robust. It's well regulated. One can't really cite for rogues and crooks, but frankly, I don't have an eye. I think we are on a very safe banking wicket as far as India is concerned.
Thank you so much, Anaga. Before I let you go, I have to ask you one question. There's a very interesting book called Cloud Money by Brett Scott, where he is advocating that everything, we're talking about digital money and digital payment systems as being the pariah for all problems. And, this is obviously a big conversation in India happening as we speak. But he advocates that no, physical money must remain, privacy and, other considerations are there, which, and Indians love physical money. I think so. That conversation between government as well as some large institutions which are pushing very hard on digital money. Where are you on that? What is your take from an economist perspective on digital versus hard money? And this is going to be the last question. Thank you so much, panelists, for bearing with us.
Hi. So again, a very interesting question. It's an emerging area in monetary economics. It's getting a lot of attention. RBI, we have introduced our CBDC wholesale, and recently came up with CBDC retail. So I think from an economist perspective, CBDC or digital currency is a very positive move, because if you improve the transmission of monetary policy. So you have physical money, which is the currency in circulation, and that money leaks out of the banking system, and you have to do it in the forms of bank notes and coins with public. But what happens is the interest rate that the central bank charges, or the central bank interest rate moves, don't apply to that currency in circulation which has leaked out of the banking system. If that money instead remains in the banking system, the transmission of monetary policy, that is the transmission of repo rate in India's case to lending rates and to deposit rates, will be much faster if that money is in digital form. And that is one reason why globally digital currencies have found favor with central banks. And everywhere digital currencies have been pushed and advocated by central banks. So I think almost all major economies in the world have now introduced their own form of CBDC, including the RBI. So in terms of concerns about privacy, I mean, yes, I agree, but digital currencies, you could have also said that about credit cards and debit cards when they were introduced, that everything will be now tracked. That you see how fast card transactions have adapted, people have adapted to card transactions. And I think that the same with CBDC will be living as well.
Thank you so much. So I'm going to end by quoting a historian called Deirdre McCloskey, who said, "For reasons I have never understood, people like to hear that the world is going to hell." So in an age of doom and gloom, I hope this webinar and its panel of optimists have given you some hope. And thank you all for being here and sharing this with us. Thank you so much. Thank you.
Thank you.
Thanks, everyone.
Thank you again. Bye-bye.